This presentation is on monetary policy. This video is sponsored by AEDU. So what is monetary policy? Monetary policy is a method by which the Federal Reserve uses to influence a nation's economy. And there are three ways that the Federal Reserve can do to basically influence the nation's economy. It can do this through securities, the discount rate, and the reserve ratio. Specifically, the Federal Reserve can buy or sell securities, increase or decrease the discount rate, or raise or lower the reserve ratio. And there are two types of monetary policy that the Federal Reserve has: expansionary monetary policy and contractionary monetary policy. And as the name suggests, expansionary monetary policy expands the money supply, while contractionary monetary policy contracts the money supply. So already you can infer that the money supply can be deliberately expanded or contracted by the Federal Reserve through monetary policy. And by altering the money supply, you are also indirectly changing the aggregate demand, which is what influences a nation's economy. So now let's examine the two types of monetary policy. First, expansionary monetary policy. So this type of policy is designed to fix a recession and do the following: increase aggregate demand, lower the unemployment rate, and increase real GDP. So whichever method of expansionary monetary policy the Federal Reserve uses, let's say buying government bonds, this will increase the money supply, which will decrease interest rate. And that will increase private consumption and investment. And since private consumption and investment are key components to the gross domestic product, the GDP, it will shift the aggregate demand curve to the right. And that will improve the economy better. And expansionary monetary policy is also used when the unemployment rate is too high. So this is a visual representation of what happens when expansionary monetary policy is enacted. So as you can see, if you were to buy government bonds per se, this will shift the money supply curve to the right. It will decrease the interest rate. So we got that. When you decrease the interest rate, you're also increasing investment, because now it's easier to get the money for investments. And when you increase investment, you're also shifting the aggregate demand curve to the right, simply because investment is a key component to GDP. And as you can see here, the price level and the real GDP increase. So now let's examine contractionary monetary policy. So this is designed to avoid inflation, and it's done by decreasing aggregate demand, and the effects are lower price level and lower real GDP. So whichever contractionary monetary policy the Federal Reserve uses, let's say selling government bonds, it will decrease the money supply, which will decrease the money supply, which will increase interest rate. So by increasing the interest rate, you're decreasing private consumption and investment, and that will shift the aggregate demand curve to the left. And as I said before, the effects are lower price level and lower real GDP, and this is done to stop high inflation. So now let's look at a visual representation of contractionary monetary policy. So it shifts the money supply curve to the left, which will increase the nominal interest rate. So by increasing this interest rate, you're decreasing investment, as you can see from this investment demand schedule. And when you decrease investment, you're also shifting the aggregate demand curve to the left, simply because investment is a key component to GDP. And when you decrease investment, you're decreasing GDP. And it also decreases the price level, which kind of curbs inflation. And since the FOMC recommends an inflation rate of 2%, if inflation is too high, let's say at 4%, then contractionary monetary policy is the best way to solve this problem. So now let's examine these three methods more carefully that the Federal Reserve can use in order to alter the money supply. First, let's look at open market operations. So the Federal Reserve, through the Federal Open Market Committee, can purchase or sell securities on the open market. And this is called an open market operation. So this sentence, basically, if we were to use treasury bonds as the securities, basically tells you what the Federal Reserve can do with the open market operation. It can either buy or sell treasury bonds from or to commercial banks or the general public. So that sentence basically gives you a general overview of what the Federal Reserve can do with Treasury bonds with the open market operation. And this type of method is most frequent. It's used by the Federal Reserve most often to manipulate the money supply. So let's look at what they can do with securities more carefully. So if the Federal Reserve is buying securities, so the commercial bank holds bonds as an asset instead of excess cash reserves. So if the bank would like to increase its excess cash reserves, the Federal Reserve can buy these bonds from the commercial bank. And the bank, in turn, will get more excess cash reserves. As a result, the money supply would increase and interest rates will fall. And you can look at the visual representation for the expansionary money supply monetary policy to see what would happen as a result of buying securities. So let's look at selling securities. So as I've said before, and as we know, commercial banks hold bonds as an asset instead of excess cash reserves. So if they want to basically decrease their excess cash reserves, or if they want more bonds as an asset, then the Federal Reserve can sell these bonds, and the bank would purchase these bonds, which means they would lose their excess cash reserves. And as a result, the money supply would decrease and interest rates increase. And you can look at the visual representation for the contractionary monetary policy to see what happens when the Federal Reserve sells securities. And open market operations are done to meet the target rate, which is the Fed funds rate. So now let's look at the discount rate. The Federal Reserve can change this in order to alter the money supply. So the discount rate is the interest rate that the Fed charges when banks borrow from the Federal Reserve. So the entire loan, when the commercial banks take it, go into excess reserves and can be borrowed by customers of the bank. So when you lower the discount rate, it makes loans more affordable to commercial banks since the interest rate on it is lower. So that means it's easier for commercial banks to increase excess reserves for banks since it's more affordable and expands the money supply, thereby making it an expansionary monetary policy. Raising the discount rate, on the other hand, makes loans less affordable to commercial banks. It means it's harder to increase excess reserves for banks since it's a little bit more expensive with the higher interest rate, and it contracts the money supply, therefore making it a contractionary monetary policy. And now finally, let's look at the required reserve ratio. Now this method is not really pursued by the Federal Reserve, but it is still an option that the Federal Reserve can take if they want to alter the money supply. So manipulating the required reserve ratio will change the fraction of deposits that must be kept as required reserves. And it also alters the money multiplier. If you'd like to know more about this, you can look at the presentation specifically designed for the money multiplier. However, since the money multiplier is not a main focus of this presentation, I really won't be going too much in depth into it. So now I'd like to put the required reserve ratio into context. In an example. So suppose commercial bank AED has a reserve ratio of 50%. That means the money multiplier is 2x. So what this means is that half the deposits must be kept in the vault and the other half are excess reserves. So now the Federal Reserve dictates that now the reserve ratio should go down to 20%. So this is expansionary. So the reserve ratio goes down to 20%. The money multiplier is 5%. So basically what this means is that 1/5 of deposits must be kept in the vault and 4/5 are now excess reserves. So this is basically increasing the money that can be spun in the fractional reserve system, which means that more loans can be given out, increases private consumption, increases investment, and increases GDP. So this example is expansionary monetary policy. So basically, to recap, lowering the reserve ratio increases excess reserves and expands the money supply, which means that this is expansionary monetary policy. Raising the reserve ratio decreases excess reserves and contracts the money supply, making it a contractionary monetary policy. And so lastly, I'd like to talk about how to coordinate fiscal and monetary policy, how it's done in the real world. So the fiscal policy is a little bit better for affecting the economy simply because the fiscal policy has a direct relationship with the aggregate demand curve on the GDP. And if you tell when you look at fiscal policy, when the when the federal government increases government spending, it directly shifts the aggregate demand curve to the right. Whereas with monetary policy, if you want to shift the aggregate demand curve to the right, you have to buy government bonds, which increases the money supply, which decreases interest rates, which increases investment, which in turn increases aggregate demand. So it has an indirect relationship. But despite this, fiscal policy has some weaknesses, and you can see that by the crowding out and net export effects. One good thing with the Federal Reserve is that it's independent of Congress and President, and it's not influenced by the politics we see. Unlike Congress and the President, they're not worried about whether or not they have to be reelected. They're not worried about their image. The Federal Reserve is independent of that, and it can do what it needs to do in order to aid the country, aid the economy. And the good thing about monetary policy is that when fiscal policy is enacted, monetary policy can cover the consequences made by fiscal policy. So let's put this into context. Suppose the United States is in a deep recessionary gap with high unemployment. So naturally, the federal government would enact tax cuts and large government spending. It's fiscal policy. So while this may shift the aggregate demand curve to the right, it has some potential consequences. It will increase the interest rate and crowd out households and firms, which will weaken AD. And that's because of the net export effect and the crowding out effect. And you can look at my fiscal policy presentation where I go a bit more in depth into the crowding out effect, but that basically increases the interest rate, which makes AD weaker, makes the economy weaker, and it kind of weakens the fiscal policy. So the Federal Reserve can kind of counteract that and bring the situation more into balance. So basically, in order to keep interest rates from rising while increasing AD, the Federal Reserve can expand the money supply by buying government bonds. So that provides a good way to basically cover the back of the fiscal policy. But they do have to watch out for inflation, but that will be the job of the Fed. And basically, by doing all this, it has the potential to help the United States get out of its deep recessionary gap, which proves to be a good thing for both the government, the economy, and the people. So thank you for watching. This provides a good explanation of the monetary policy that occurs with the Federal Reserve and the United States economy. My name is Vinay Gonagolno, and I look forward to teaching the next presentation with you guys.